From Daily Forex, this is Chris taking a look at the indices in the United States, E-mini contracts. This is the S&P 500, and you can see a very bullish candlestick. What you can't tell just by looking at the daily candlestick, though, is that the market had actually sold off quite drastically and looked like we were going to roll over a bit. Got through Trump's speech, shot straight up in the air. So it's more of the same. It's liquidity. The Federal Reserve is buying junk bonds. That's what started all of this from down here. And now we're trying to test this rectangle of resistance, which goes up to 3,100. I look at pullbacks as potential buying opportunities. Don't worry about earnings per share. Don't worry about inflation. Don't worry about growth. None of those things actually matter. What matters is price action. This is about how much liquidity the Fed is throwing into the marketplace. Wall Street knows the Fed has their back, and that's how this market has behaved since 2008. So at this point, you should always keep in mind that these indices are designed to go higher. So take the NASDAQ 100. You know, we had the same reaction and we rallied. We're above 9,500. We're going to go to the all-time high. Well, think about who makes up the like 35-ish%. I haven't really looked at it lately. The actual weighting, but you have Netflix, Microsoft, Facebook, Google, which is Alphabet now, and Amazon. That's like almost 35-ish, 36-ish% of the index. So of course it's going to go higher. Those are all the same stocks that everybody buys. After that, you're looking at Tesla and Intel before you get to the rest. You know, keep in mind that both of these indices share something in common, and that's like the top 10% make up all of the gains. So when you're buying an index, you need to know what you're buying from a weighting basis. I don't even know what NASDAQ 97 is, what the company is, but I can tell you it doesn't matter what it does. It's got nothing to do with this index. Or at least it has such a little impact on it. It has nothing to do with how it trades. So as long as the darling stay-at-home stocks that I mentioned are going to continue to be in high demand, and things do look good for those companies, stay at home, work from home, that type of thing, plus they have plenty of services and goods that people are going to use anyways, well, I don't know how this drops. We could get some type of major economic event, but even then it will only be temporary before the Fed steps in and saves it. So that's my honest opinion. It's, you know, if you know anything about the economy and what's been going on, there's no justification for this other than it's that handful of stocks. So keep that in mind. I think 9,000 is going to be your floor. I think 50-day EMA is going to support it. Granted, that's almost 600 points away. But that tells you how bullish this market really is. We got past that gap. That was like the last bearish sign. There's almost nothing to keep this from reaching the highs and then 10,000.